and ensuring that we're writing loans that we can sell and that are good loans and stay within compliance per Fannie, Freddie, VA, FHA, USDA loans. We also do non-QM loans, which are not those types of loans, but Rick does not do those. We're not getting into non-QM, but just know that we can do your DSCR loans and your bank statement loans for your self-employed borrowers. We also have no income document loans, which are great loans that we can also do, and no ratio loans that are also great loans. So we have a lot of different loan products out there, but we're strictly going to be talking about all the normal type loans with Rick today. So thank you again, Rick, for coming.
No
I
problem, guys.
appreciate your time. We're going to try and keep you till 1300 my time, 1 o'clock our time. You're on the East Coast, so thanks for waking up early and doing your
Oh, no
hair.
worries. No worries.
Looking sharp. So yeah, thank you again. Go ahead, Rick. I think similar to what we did last time, you go ahead and hit us with 10 or 15 minutes of incredible underwriter knowledge, and then we'll hit you with some questions.
Of course. And feel free, guys, to just ask any questions you like, interrupt to ask a question. It's really about for you guys. It's not really for me to sit there and hear myself. I actually would like it more interactive to where if you guys have any questions or scenarios, and I may not know the answer right away, but I can definitely look it up and get you the answer, which I did in the past too. So there are some changes happening to Fannie and Freddie when it comes to condos and master insurance and things like that. And I don't know if you guys have already heard about it, but I can go over certain things on that part of it, and I will go over that part, especially if you have condos that are coming on board and coming on as potential buyers that are buying properties in condos. Affordability, of course, I'm in California, so most people are buying condos in California. Most new developments are condos, are very rare to get a tract of homes not being condominiums. We're seeing 3 unit, 3-story condos. Bottom is the garage and two other and 3 stories total for these condo complexes. So building up because the land is scarce. But there are some good news for condos. There's some bad news for condos too. The one bad news is that it will affect everyone. Will be the limited review process. So if you're not aware, limited reviews something that is great to have when you don't have to verify, all the nuances with the condo complex, including budgets and reserves. So what Fannie and Freddie did was no longer allow the limited review, but no longer restrict the 50% ownership as a non-owner. There's no restriction for non-owner as long as it's not considered a condo-tel or a vacation area, resort area. Which again, Fannie and Freddie look at it too differently, by the way. Fannie looks at it more strict. Freddie looks at it more. If there are a bunch of vacation homes, they won't consider it as a vacation rental. Where Fannie is like, no, it's considered as a vacation rental when there's multiple condos listed on VRBO or on vacation sites. So Freddie actually
So,
allows more of it. So we actually
so
have turned loans to Freddie. Go ahead.
So Rick, how does that affect the because we're in front of a bunch of real estate agents, so we're trying to keep
Yes.
it more driven towards that, as you know. How does that affect like a potential listing with the limited review, the listing agent and the buyer's agent, obviously for sure too, but how
Right.
does that affect that, do you think?
Cost to your borrower, right? Because they now have to get the full master, full condo questionnaire, most likely, because most condos are not reviewed by Fannie Mae. So most lenders like us, the large lenders, review our own internal condos. So we pretty much review them. So what that means is more cost to the borrower, which means every condo now, regardless of they're putting 20, 30% down, requires to get the budget, the full condo questionnaire, the master insurance instead of just having a limited review, which it's a short form questionnaire, which you can even call to get the information from the HOA directly or the property management company. You can just call and get this information and fill out a limited review form, and you don't need the budget, reserves, CCNRs, and things like that. Now, with that limited review process being gone, just more cost to the borrower. And that's something that, not in agreement with Fannie and Freddie by removing the limited review, but understanding that they did take away the restriction of having the rental units being at 50% owner occupancy. So that does help a little bit, but it does hinder in the fact that it's just going to cost the borrowers more money. So they have to be aware
Yep.
that when they're buying a condo, you're going to have additional costs besides just your loan closing, things like that. You have the condo, and plus transferring the condo, you also have condo reviews that are required. But good loan officers, good branches, and good people like the ones we have on the call with Cregan and Courtney and them, they email us to find out the condo's already been reviewed by Fannie Mae, if it's already been approved. Once it's already approved with Fannie Mae, or if you're going FHA, if it's already approved with FHA, it just makes it a lot easier. It's a lot quicker process. So some of these
Yep.
condos are reviewed by Fannie Mae, not all, not majority, but some are. Specifically in your guys' area, has good amount of reviews, but typically in Florida, there's not a lot of reviews being done unless it's a new construction. But the other part is that the with the condo, the master insurance, it made it a lot more easier, guys. If you've ever been dealing with the lender and they're like, we're contacting the master insurance because of deductible, because of the coverage is not there, they've made it more lenient to where they'll allow a higher deductible, they'll allow per unit deductibles to be higher. All that information helps the borrower qualify for the condos. Now the process get longer, but it is going to help ultimately the borrower have get approved with the condo because they've allowed certain leniencies on those master insurance, not to verify if the roof is under cash value or is it, full replacement cost. Well, and that affected a lot of condos, by the way. A lot of condos were getting declined by Fannie Mae, and it affected the borrowers because they would have to go into a non-warrantable condo situation where they were paying higher interest rate by going non-QM, and which is not a bad product, but it is a higher interest rate, and it's not for everybody. But we had perfectly good, full qualified borrowers going into non-QM because the condo complex was considered non-warrantable, which is allowed by non-QM lenders, but not by us as an agency lender, which is Fannie, Freddie, HUD, USDA, and things like that.
Yep.
So it will help that.
Cour- Courtney had something to add to that as well, and then
Of
we'll
course.
would you?
Yeah. So typically, I want to go over misconceptions. When we have a buyer that's buying a condo, we will get a message sometimes if an agent sees the CD that went out or anything and saying, why are you charging my borrower for a condo documents? We already got you the resale package. What people don't understand is the resale package you get on the listing side is missing the budget, the one sheet or everything we need. So we have to reorder it. I call it like a dupe. It's how condos make money. So of course they're going to give the seller one thing and then what I need to close the loan isn't in it. And what he's saying now is when we did a limited review, we didn't require it. So we just fill out this short questionnaire and be done. But we always budgeted for it just in case we didn't get the approval to have a limited condo. Usually you needed to have 10 to 20% down. Most people don't, right? It's not common to get it, but we would tell them when we got in trouble with the condo, can you find some more money? Because we got a workaround because we won't ask this question. And what he's saying now is every borrower will be charged the condo fee, which is
Yes,
typically 450 is what we quote. We only
yes.
charge what it comes in at. Some charge $100 per page, some charge 450 off jump, some we have to go to their office and physically collect it. Like it is not streamlined at all between condos, and everyone will be charged it now, no questions asked. And we will always need it because everyone, I hear it 1 in 5. Why do you need that? We gave you the resale package.
Yep. And
I don't care about your resale package. Don't even send it to me.
I've
Nothing I need in it.
I've personally been to the one on Bendix Road at least 3 times in the last like 15 months to show face, to the point to where the lady saw me last time. She's like, "Oh, good to see you." I was like, "It's great to see you too." Because if you go in there with a big smile, she actually went above and beyond, in her opinion, probably. So
I heard was Sin Cragen.
well,
Yeah.
to the lady on Bendix Road, we're good. But the good part is that that one on Bendix Road is probably the largest condo manager in all of Virginia Beach, Norfolk, and Chesapeake, for whatever that's worth. But yeah, thank you so much for that great knowledge. I love that she added to that on the condo stuff as well.
Yes.
Me, Cragen, and Sin
Yeah.
Cragen. That's
Yes,
And
absolutely.
now Courtney's actually become an expert because she's actually gone through our PERS process, submitting to FHA to get condo approval, VA condo, because she actually went through the process with us. We got on conference calls and went through the process. So it helps that our loan officers, our branch managers, and leaders understand the condo complex and how it works. So,
Yes.
and look, yeah, I don't want to waste all our time on the condo. It's just something some coming out, and I'm getting a lot of separate emails from different companies, different underwriters from different companies that are calling me to going over their condo review, like how their lenders doing their condo review. A couple of companies here in California that have called me to ask, what I think and what we're going to be doing as far as internally for our condo reviews. So, but good news is that it is going to be easier. Bad news is it's going to cost more. So
Yep.
take the grain of salt, whichever way you would like it, but will be easier for the qualification process will be easier. A lot less innuendos and going back and forth with like master insurance and terminologies that we're not insurance agents. So I'm not sure why Fannie would think that we are insurance agent as underwriters or reviewers. We're not. So there's certain things that we're not aware of, but they dumbed it down now to where it's just like, okay, if the master insurance policy provider is going to do it, it's going to be fine. If they are going to use actual cash value on a roof, okay, that's something that's already built in. We also collect for reserves. We also collect for money for replacement of roof. There's all these things already been done in place, not just worried about the building being burnt down or going to the ground. There are things already in place to cover that. So that's good news on
For
on
sure.
that part of it. There's really been no major changes as far as credit and policies, as far as Fannie and Freddie. FHA, as you know, has basically has not had a major update. But the one update that keeps coming back and forth, and I'm not sure if your clientels are into this or if you meet borrowers are into this. Um, I believe you guys are in Virginia, correct?
Yes.
Yes. Northern, southern, mid,
Southeast.
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 All right. So I
Near
know a
North
little bit of
Carolina.
Virginia because my family still lives in Alexandria, and my parents lived in Fredericksburg, which was a little bit more south. But that's the extent of it. When I was going to visit them, I just drove on that long freeway to get to Alexandria for my brother, to my mom and dad in Fredericksburg. That's all I remember. But there was a lot of population of that when I went there with my daughters actually a couple years ago. There was a lot of Venezuelans and Salvadorians and things like that of immigrant borrowers that are most likely in those situations have either temporary protective status and things like that. Where FHA, you have known that now that they have gone away with that product, where they're not allowing any type of temporary protective status or non permanent resident for FHA. While Fannie Mae has allowed a lot of these. So even if your borrowers are Venezuelans or Salvadorans with a temporary protected status, the TPS, are allowed to still participate for Fannie Mae. Freddie Mac, not as much. Freddie Mac actually not, but Fannie Mae does allow it. So we still have an outlet for Fannie Mae. There are lots of talks about Freddie Mac and what they're going to come out with as far as the policies on what they consider non-immigrants. Right now, it's very, very, restrictive in the way that they word it, and they have come back to us in the past couple of years. We've had a couple of loans come back because they would not accept a certain like DACA, which is popular more in California, but DACA borrowers. But we also had a TPS borrower that was turned down by Freddie Mac. Luckily, we also run a DU, so we were able to sell that loan to the agency on the other side because Fannie Mae bought that loan. But we always run double AUSs in our company just so we can have protection if something happens. But in those cases, we had to sell them to Fannie Mae, and that's why our company. People think it's an AFN overlay because it's listed under it, but it's actually not. It's actually Freddie Mac not accepting temporary protected status and non-permanent residents. Now they will accept visas as long as you're legally allowed to be with the visa holder. So I know Courtney and you guys have had borrowers that had visas or immunities or not immunities, but had work for World Banks and things like that. You guys have multiple type of borrowers that
Yep.
come through us. We were able to do those. We learned a lot from it too, by the way, as far as my underwriters and my managers because they weren't not privy to it until I got involved and worked it out with them and told them what needs to be done. But those are things that we work on a lot. So Fannie allows it, even though FHA and Freddie Mac does not allow it. By the way, VA allows it. So if you have a borrower and a spouse, the spouse happens to be uh, um, uh, having a TPS, VA will allow that too. So there's a misconception VA doesn't allow it. No, VA actually allows it. It's not same as FHA, even though they sell to the Ginnie Mae pool. FHA has a specific guideline, VA does allow it. Okay. So that's something that if you have a
That's-
veteran bar that's married to a person that has TPS things, you can still use that person's income to qualify and residual and everything. Because there was something out there that I read in a post somewhere, board with different underwriters that, oh, you can't use that income. That's not true. You can use that income only if it's not permanent, where it's really temporary, like if it's a certain bar, like from Ukraine, which could, potentially be put away, or certain Venezuelan that were issued back in 21, 22. Those are considered temporary because those were not prior to those dates, unless they had a prior history. Those were not going to be renewed by the current administration. So uh,
Yeah.
again, if it when in doubt, we have great scenario desk, and you can always reach out to it. So if you have Courtney and Greg, and just reach if they have any type of scenario like that, which you have a bar that's particular that you need to get know about, send it to them, and they will send it to us, and we will review it and let them know what exactly we can and cannot do for those borrowers.
Yeah,
Um,
definitely.
yeah,
That we definitely see a lot of those because we are a transient area for sure,
yes,
where we live. We're definitely not New York or Miami, but we definitely have our fair share of those types
yes.
of borrowers for sure. So to switch gears, what do you feel like you are seeing from a perspective of borrowers running the edge of not qualifying or having to get loan denials because of XYZ work that could be maybe be done up front by a listing agent or a buyer's agent prior to getting under contract. So just, maybe a small bullet hit list of things that you've seen.
Number one, it's income, qualifying an income, whether it's self-employed or if it's variable income. So when you get borrowers that are self-employed, those are the ones that typically will tell you their whatever the monthly income is, right? And everybody goes off that monthly income, like, okay, we think it's about this much. Okay, great. Well, they don't tell you whether that's what they actually use for tax returns, right? So this is where we have certain loans that Reagan brought up, was like the 1099 programs, the certain programs that are made for bars, like the bank statement loan programs that are considered non-QM, that are made for these bars that have high net worth, high assets, but just don't report that to the IRS. Nothing wrong with that. They want to do that, and they want to have a lot of deductions and not report they report the gross but not the net, and the net becomes really low. They're still a loan that we can do for them. We actually do them a lot. Like, we actually have a department. RJ is the gentleman that handles that department. He actually came on board. I actually tried to bring him on board here with us, but the non-QM department going through our corporate, so I got him hired at corporate. And so he's been doing great there. And then he has a few, like 4 or 5 underwriters that work under him. I forget if it's 5 or 6, or it could be 4. But they work directly and they only work on that product. They're not working on conventional loans or FHA. They only work on those products, the bank statements, DSCR. So they're experts in that product. And we can still send it to scenario desk, and they'll review it, and we'll pay the fee for bank statement review. But those are the things that get caught up. But it's not even self-employed as much right now, guys. It's really borrowers that are working on an average daily job that have variable income. There's so many ways the calculations are being done. And I always give this example. If I give the same pay stub, same W-2, same written VOE to 10 underwriters, I would get about 7 different answers. Hands down, I would get 7 different answers, because it's just going to be where it's what is considered, what you think maybe, oh, conservative or not. And I don't believe in, I just say, if the give the income what they've earned, right? If the AUS says 1 year plus year to date, use the average, use that 1 year plus year to date. Don't try to add to it. Don't try to, you know, dissect it. That's not purpose. It's not a good purpose for us to do that. However, Fannie Mae actually came out with something that I've been doing this since 2012, where we would get Fannie Mae loans back, and I would redo the income based on their new pay raise. So when you have a borrower that is working hourly or even salary, but mainly hourly borrowers, ask them when was their last pay raise. That helps. And believe it or not, that helps. So they say, well, I make about, $30 an hour or $25 an hour, and I make about this much a month. And say, well, okay, well, when was your last pay raise? Oh, I happened like 3 months ago. Before that, I was making like $22. Great to know that, especially if you have FHA bars, because that changes how we can calculate income. Because now what I can do is if their hours are fluctuating and they have different hours working, which is fine, which is normal, get the information on how many hours they work for the past 12 months. And the hours that they work, I can use a new salary. Instead of averaging all their hours, I can use that and even the overtime and get the higher overtime for the hours they work. I actually get more income when people get a pay raise than if you don't tell me about it and we're averaging for the past 2 years, year to date, and all that stuff. So I prefer when there's a bar that has a pay raise in the last whatever. It could be 2 years
So
ago. It could be
so
2 years
that
ago.
so that could be a good turning point for a real estate agent that has a client that they were working with and they maybe got denied or something a year ago. Maybe now is a good time to reach back out to them like, hey, John Smith, did you get a pay raise in the last 12 months? Because if you got a $3 an hour pay raise, maybe you now qualify for that home that you were trying to shop for. So,
Exactly.
add these to your future buyer consults or your touches when you reach out every quarter or semi-annual, however often you as real estate agents kind of reach out to your clients. Maybe throw that out there. If you have somebody that was not qualified or whatever, just say, hey, if you got a pay raise, you might be able to use that additional income to help your purchase power or your buying power.
Yes.
So yeah, that's all. Those are all good. I agree with the self-employed for sure. And then we always say, you make 200,000 dollars in your business gross receipts, and you feel happy, and your accountant's like, yeah, man, I hooked you up. You only made $20,000 on paper. That's great from a tax perspective, but when it comes to buying a house, unfortunately, it doesn't really work out very well. But there's also options as well, because there are times when I'll let Rick get into it a little bit with from a standpoint of the self-employed, where you can actually purchase a home on your self-employed income with only 1 year of tax returns. It's not always 2 years. So Rick, if you want to spend maybe two
Yeah.
2 or 3 minutes on the semantics of how all that works and what additional documentation might be needed from the person that has that self-employed business, so that the
Right.
agents can kind of take that in. So when they're doing their initial buyer's consult with the self-employed person, we'll say, hey, well, you might still be able to qualify, you know, from that perspective.
And I'm glad you brought that up because I actually was given more information yesterday. And by the way, I'm going to discuss it with the underwriting managers. We're going to have a conference call on it just to make sure I do it properly and what we needed. So Fannie and Freddie both, not forget FHA for right now, right? Just Fannie and Freddie. Even though FHA is a great product, but you already know 2 years self-employed, 2 years of everything. But typical
VA as
FHA
well.
borrowers,
VA is also 2 years too.
yeah,
So
VA is also 2 years. FHA and VA borrowers are typically not your self-employed borrowers. And I'm not saying that it's not typical for you, but I'm saying in the mortgage industry, typically FHA and VA borrowers are not self-employed. You usually get borrowers that are working class borrowers that don't have self-employed that usually go for FHA and VA. But as self-employed borrowers, majority go to Fannie and Freddie. Well, if they've been in business for 5 years, then don't provide, if you've done your 2024 returns, you haven't done your 25 yet, it's on an extension, just give your 24 returns. As long as we can prove that 5 years. Now, here's the kicker. Freddie is a stickler on the 5 year rule. They want to show either if it's a schedule, like if it's a partnership, they want to see when the business was created, all these things, right? They want to know, they want to get bank letters. If you could, to prove the 5 years, you have to prove the 5 years. It only becomes an issue when your bar is a Schedule C bar, where they're a sole proprietorship and they're not using a business name, like not a DBA. So John Wick, John Wick, I do this for a living. All right, well, that's your name and you're considered Schedule C, but you don't have a business name. We don't know how long you've been in business for. So Freddie has taken a very hard line on that. So Freddie's just like, well, you need to get something reputable, this, and this. Fannie says with other supporting documents, you can prove with the CPA letter, where Freddie does not allow CPA letters. So Fannie actually says, well, you can get a CPA letter as long as you have other documents to support it. So we can actually go back and say to the borrower, well, how do you get paid? well, I get, 1099s from this company, this company. Okay, you get 1099s. Can you get me one from 2000? 2020, sorry, 2020. If they give you a 1099, regardless of what the amount is, don't pay attention to the amount. We don't care. We're not qualifying. But if they get like a 1099 from 2020 and they get a CPA letter say, this bar's been self-employed for 5 years, and you have a retrospective 1099 from 2020, you can kind of prove the 5 years. So we're actually now it's even better because now we can go for Schedule C bars that just use their name solely. But if there's a way to prove it, as long as they're telling you the truth, we can prove it. We can use 1 year returns. It only becomes an issue when it's a Schedule C bar, by the way. It doesn't become an issue when it's an LLC or S corp or a C corp, right? We don't get issues like that. We only get issues on Schedule C
That's
bars
great.
proprietorship.
Yeah, that's great
But
information.
yeah, Fannie came out with that, but Freddie. So I will have a meeting with the underwriters on what they can accept. Because right now we had a hard line based on what Freddie and Fannie told us before. But at River, and we had a question on the file, and I'm like, River, call Fannie, and forget Freddie for right now. Call Fannie because I already know what Freddie does. So he called Fannie Mae, and they're basically like, yeah, you're fine. We were like, what? Like, okay, get a CPA letter, get a 1099 from 2019, whatever it is. Yeah, you're good. We're okay with that. Are you good with it? That's what they kept us. And we're like, yeah, we were good with it before, but you guys are the ones that are pushing back on it. So, yeah, so I will have talked to the manager. So that's something that's going to come out, recently. I'll have Jim McKee send out something regarding what we can do to verify that. But yeah, bars with 1 year returns is very popular for us. We do a lot of those at AFS.
Yes,
1 year
absolutely.
returns.
So yeah, that
Um,
was great. Just to double back, I know a lot of people on this call have or here today have heard me say Fannie and Freddie. When we say Fannie and Freddie, that we're just basically saying conventional loans.
yes.
So whenever we say Fannie and Freddie, those are the two independent I guess we would consider them what a public-private partnership where they work with the
Yes.
government, but they also are private as well, where the government is there to ensure that they don't fail for the most part, but they are still a private help me out, private overseer of conventional loans, right?
Yeah. Yeah. They're basically a public company backed by the government. So they are
Yeah,
backed by the government.
public-private.
Fannie and Freddie
Yep,
both are.
yep.
So they're just a GS. We call it
But and
GS,
you
whatever. So
And,
yes.
and I just found this out from Matt Schultz, who's our boss, Courtney and I's boss, that I guess Fannie is publicly traded. You can literally buy
Yes.
Fannie Mae stocks. And I guess when certain things have come out this year, Matt said, go look at X date. And it was crazy how the stocks had went up for Fannie when they announced like some big thing that Fannie was doing now. Um, so it is interesting how things work when it comes to that regard. So I appreciate you
Yes.
explaining the self-employed stuff.
Yeah.
Next
Fannie
question I
Mae
have.
is $7.42 if you want to buy it. It's per share. So that's
Yeah,
what you guys know.
yeah. So it's
As
not
of right
bad.
now.
Not bad. Yeah.
Yeah.
Keep an eye on it, right?
Yeah.
Um, but the next question I had is rate. So rate is a huge topic of conversation when it comes to real estate agents and just in real estate in general. I always say people that don't know how to ask good questions always, and don't take offense to this, anybody in the room or online when I say this. Um, People that don't really know how to ask good questions when they first see me as a loan officer say, "Hey, what are rates today?" Right? Because it's just a way to start the conversation, right? Not and it's not a terrible question, but it's such a loaded question. So I say that, and can you help us from the perspective of an underwriter to say a real estate agent? How do different qualifications or different items in the loan application how it affects rate?
Yeah. So a couple things. There's only a couple things that you can look at. The first one is your FICO score, right? That's something that's already given. And there is a pilot program coming out with Fannie Mae and Freddie Mac in regards to an additional scoring. Um, I don't have the top of the name of the scoring, but there's a new scoring
Vantage,
model. What's
the
that?
Vantage 4.0.
Yes, that's it. Yes.
Yep. I just
So
sent that. I just got an email from Housing Wire about that yesterday and sent it to Matt, John, and
yes.
Brian and said, check this out. 99-cent credit reports.
And yeah, yeah. It's a pilot program right now with Fannie's working out the kinks. There's also a couple other pilot programs regarding alternative title. If you were from 2000s doing loans, you would see that we were using alternative titles back then. We were doing lines of credit on a short form title, right? And that is something that is coming out with Fannie and Freddie, where if you run that short form title, it will actually give you a warranty that hey, you're good on your title, so you don't need to get an additional title report, which can save lots of money in title insurance and things like that. So basically, you're going to insure your title with this tool that they have, and it's also coming out to the. It will probably won't come out to the public until 2027, 2020, well, 2028, most likely. What do you mean all the lenders? But right now it's a pilot program that they're running. They're also running the pilot program for the credit score model, which then will help cost and things like that. But credit score is one of them. But believe it or not, your DTI is another issue that you have because there are LLPAs. There are basically pricing involved in a higher debt to income ratio.
So, so LLPAs, just to be clear, I know y'all maybe heard me say this before. LLP is an acronym that stands for loan level pricing adjustment. And
Right.
basically what that means is if you have a higher DTI, like he's talking about a debt to income ratio, then you would get a hit on your loan level pricing adjustment, meaning your rate is now a quarter point higher. It goes from 6 to 6.25 because you've got a super high DTI. You're pushing the limit of not qualifying.
Typically anything over 43, 40, 45%. I'm sorry,
Yeah.
45%, things like that. You do get, there's not, basically it affects that. It also affects if you're putting 10% down, you have mortgage insurance, right? So yes, the rate is a factor, but you also have mortgage insurance, which we have tools that we can run to see who's the best mortgage insurer that we can, private mortgage insurance that we can use for the borrowers that are putting less than 20% down. So, those are all factors because you can have somebody giving you a good rate, but your your PMI is through the roof because they didn't do the research to get you the best rate. Or it'll change because they quoted based on your 30% DTI, but your actual DTI is 46%, 47%. So those are all things that affect you. Besides your FICO, your debt to income ratio affects your pricing. Condos affects your pricing, right? Whether you're buying a single family or a PUD compared to a condo, those are different pricing. PUD
Yeah.
doesn't have an LLPA, but condos do, right?
Yeah, I will
Um,
say that the condos in general are about a quarter point
yes.
rate hit usually.
Even
If
a
it was six,
detached condo, which I found
yeah.
out, even doesn't matter if it's detached or not. Condo, it has a higher pricing. So
And it's not much, guys. We're only talking like 0.25%. So like I said, if you had a 6% rate, you're only looking at a 6.25. So if you have all the things and you're quoted at 6%, but then you're in a condo with a high DTI and you're only putting 3% down on a conventional loan, the things that he's kind of discussed so far, you're going from a 6% and now you're at 6.5, and you're like, damn, what happened? Well, you know,
yeah.
you
But
have more
we
risk
also get
here.
benefits on certain counties and certain zip codes that if you're buying within that, there are some LLPAs that you get deducted for buying in a community that needs to get revamped. So we also have programs that you guys, I know Courtney and you guys have used before, where we're getting community lending points for it, right? Like a CLP program. So it's run through one of our investors, but we also have a community lending program where if it's in a certain zip code or a certain county, you get certain pricing back to help loans in that community. Those are things that, as realtors, you guys would be getting involved with your loan officers because they're going to look that up for you. They're going to be like, oh, yeah, you know what? I can probably get this borrower a better rate. Not, it may not be the upfront conversation, but first things first, qualify the borrower, right? That's the most important part is does that person know how to qualify that borrower? And with the confidence that we have with our LOs, like we are very open. We're ready to call, do scenario desks. We have underwriting managers and myself. I see the response that happened on that. And if I miss one and something happens, I get on the call with the loan officer, right? Because if there was a wrong response on the scenario, or if I need to correct something that happened, or I need to dig deeper because they might have asked a very granular, a very over the top, just an umbrella question, but need to get granular into that for qualification purpose. We'll do a phone call, we'll do an email, and get on a call together to discuss it. So support is here, but again, underwriting has now transformed more into qualifying the borrowers and not just is it approved or denied? Literally we have to like sit there and see how this loan does. Now I'm gonna tell you this right now, as far as AFN and basically mortgage companies in general. Our butt is on the line for 3 years on these loans. 3 years. It's not, we don't live the life of the loan. We're not promising the borrowers to pay for 30 years. That's why there's a lot of rules in place for like, is it 3-year continuance? Does it make sense? Is it stable? because as a lender, we are responsible for the first 3 years. After the 3 years, no matter what happens to that property, we're not responsible as the lender if it forecloses or something happens to the borrower. We're not liable. Even in the 3 years, if something happens that is uncontrollable, we're still not liable unless we made an error on that. So a lot of times people will say, well, how am I going to sell this to an investor? Would they buy it? Well, is it going to perform? Right? So if you have a borrower with a 580 FICO, does not mean that it's not going to perform as good as a borrower with a 700 FICO, right? Because I've seen files with people with 740 FICOs default on their first payment. But I've
Yeah,
seen borrowers
of
with,
course.
yeah, 580 FICOs have a loan with us for 3 years, 4 years,
And
and they finally get enough good credit to refinance, and we refinance that loan.
yeah,
But
you brought up a good point too, and I said this in our last team meeting here at Coastal Town that we always have to make sure in your buyer's consults that these people realize that they have to make their mortgage payments on time. It will affect their debt to income, or I'm sorry, it'll affect their FICO score. Additionally, we just got a buyback because of it, because we had a client and he happened to have like a 590 credit score on a VA loan, but we got it pushed through. But what did he do? He was late on one of his damn mortgage payments within the first 6 months, and we get a full buyback. We
yeah,
get a full buyback because of that. So we say that in your initial buyer's consult, please have these conversations with your buyers that you have to make your mortgage payments on time because it will affect your FICO. You don't have to put in this going to affect us and our commission. That's not what I'm saying, but
Because it does.
because it does. But just so they understand that you have to make your mortgage payments on time. So
was that
just to
Courtney
hit
in the
the
back? Was that Courtney in the
yeah,
back saying that?
yeah.
I thought it was funny because I heard somebody's voice in the back.
It's like, I just don't understand why you won't help them, right? There is guilt. You're like, look, they don't have the best credit profile. This guy had already foreclosed on a house years ago. He was VA, but yes, he actually had a higher credit score, like a 680. But we
Yeah.
were able to find funds to close or wasn't dollar bank. And I said, man, he's a professional and he doesn't have a dollar.
Yeah, he had a good job. He had a government job and he's VA.
Ready. Yes. And he was older.
Whoa.
Again, and I just say it cost us
Yeah.
so much money, and we don't find out until like a year later after he defaults. So he's going to default in a 6 payment. You don't make payments till 2 months after. So a year later, I find out that everything's taken. The bonuses I paid my employees, the hourly rate I paid my processors, the fees we paid on the back end don't even get charged to the borrower on paper.
No.
Like, and I knew I was right. I went through all the text messages that I got from this agent that were so nasty. Like we did a 60-day close because he wasn't prepared. And I said he shouldn't be buying. I said it multiple times.
Yeah.
The price point was 700,000.
Yep.
Of course they wanted me to close. Of course I want to close it. But I knew my gut was right. And I even told him, I said, you've got to make your payments. I said, if you can't, just call me. Just fucking call me.
So
$500 to make a payment, then you not make it.
Do
Like,
they
Yeah.
take that back immediately?
fuck yeah.
yeah,
take
they
it
take it.
over
Yeah. So
My loan officer, since I run the branch, I also will garnish their wages
yeah.
because I need that money back.
Yeah.
People just
Yep. So that being said too, so just the big hitters on what affects the credit profile from a loan perspective, we have the DTI, the loan to value, the loan amount actually affects it as well, right?
Right.
We've seen lower, surprisingly enough, $175,000 loan amount will actually get a little bit better pricing than a $500,000 loan amount. I've seen that for whatever reason. So and then FICO, those are pretty much the big hitters, Rick.
Yeah. But as far as the one that's unknown until later on is the DTI, right? Because a lot of
Yep.
those things are already built in place. But if you have put in a DTI at 40% and then you price out the loan and then the rates get different because the DTI is a little higher because of the calculation of the underwriter, those are the factors. So honestly, rate is one part of the qualification, but right now the main goal is are we giving loans to the borrowers? Are they affordable? Can they afford it? Now, in that case, in person, the borrower had a FICO score. Yes, he was making good money. Yes, he had probably met the residual. Yes, he probably had over 2 years from the last foreclosure, which VA said don't worry about, right? He met all the check boxes. But Courtney brought a good point. How come he doesn't have any money if he's making this good money? Where's the savings at? Why does he need a 100% loan? I mean, we don't mind doing it, but what's going on here? Well, we don't know what his expenses are outside of what's listed on the credit report. He may have issues outside of handling his money,
Yep.
right? To where
Whether it
he
be
has a
gambling
savings.
or
I don't know. I
gambling
didn't say that. I'm
or
not gonna say
God
that.
knows what.
Yeah.
Yeah. So I have a good question coming up from our partner here, Chrissy.
Yes.
If you want to go ahead.
Can you hear me?
I can hear you. Yes.
So I had a question. Like when you get the appraisal back, sometimes the underwriter has separate conditions above and beyond what the appraiser has called out. What are you looking for? Like what is in there that is immediately like the red flag?
100%. By the way, it's a great question, and it's actually a very sore subject that's been going around within our
It's not a
company.
sore subject to me, especially if I'm the buyer side.
Yes, I know. I know.
I want you to
We call them,
bring me more.
It's
I'm the buyer side. I love it. Please.
it's a
So-
critical condition when it's just a comment. What is it called? It's something when it's actually something that needs to be repaired. There's two different words we use that one, but it's an appraisal revision basically.
Is it material or is it it's just a clerical finding? Like,
Clerical or, yeah.
yeah, material.
Yep.
We've
But-
been doing this a lot lately,
but-
'cause I
but-
think there's been some changes.
But
Yeah,
to-
so go ahead with what you were gonna answer, Chrissy's question, sir.
So yes, so what we're mainly looking for now, we have collateral underwriting that reviews it. The clerical errors are things that the appraisal company, the AMC, should be monitoring. Like, hey, did you do the correct ANSI measurements, right? A lot of times the mistakes are just the calculation of the square footage because they are using like less than 5 feet of a, like, let's say you're in an area where the house has less than 5 feet from the roof, and they're still using that vantage point to get the square footage or things like that, right? But those are very, minimal. The main concerns that you get is when we get comps back and we see the sales comparables, and nothing is bracketed, meaning you have like, let's say you have a 3 bedroom, 2 bath. And I'll give you an example that actually happened. 3 bedroom, 1 bath. Every single comp the appraiser provided, I'm sorry, 2 bedroom, 1 bath. Everything the appraiser provided was 3 bedroom, 2 bath. Every single comp. Every sale was 3 bedroom, 2 bath, right? But yet your house was 2 bedroom, 1 bath. The house actually is worth good money because it had a basement. The basement had additional bedrooms and things like that. So there is value there, and it could probably sell for that price around that range because people, it's more important to them. But the appraiser himself just provided 3 bedrooms, 2 bath, and made some really big updates on the adjustments, right? High adjustments to cover that 3 bedroom, 2 bath. Like, give adjustments on that so that way it can line up with the purchase price a little bit, because those homes are selling for a lot more. So he negative this, negative that, negative deduction for 30,000, 40,000. Well, every loan, whether it's Fannie, Freddie, or FHA, as long as it's a single family home or a condo or a PUD, not a multi-unit or not a manufactured home, so we're not going to talk about those two, goes through a scoring system. And that scoring system tells you the overvaluation risk. So we actually use tools to tell us that. Okay. And if that has a high valuation risk, plus none of your comps bracket our property, that's an issue. That's a red flag up front. Just know that you're going to get that. If he provides 7 comps to support a value, you're going to have a problem. Okay. Because he went and used too many comps to justify that value. If an appraiser uses more than 3 comps to support the value, there's an issue, right? And I've seen that happen where they provide 6 or 7. They'll go outside the area. They'll go to another city, which they'll say similar characteristics as this city. And you guys are the experts in real estate. You guys know that not every city is aligned, right? Like this city you can already tell what's more desirable. Is it this city or this city? It's very rare to find 2 comp cities that you're like, oh, buyers would be okay buying here and here. I'm not saying it doesn't happen. I'm not the expert on that. You guys are, right? You're the realtors. You guys know
Yeah.
what can sell, what can't sell, what the value is, what not the value is, because you guys deal with it on a daily basis. All I see is a piece of paper. I'm not in that area, so I can't physically know what's happening in that area and how the market works because I don't live there. Most appraisers, even though the appraisers live in that area that are supposed to live in the area to give the best value, they may not know that the difference between one city to city. Or they do know it, but they don't know how to portray that to us. They don't know how to communicate that to us because we're only getting a piece of paper and what they just basic comments. They can't really go into details, but this is their basic adjustments. That's where it becomes a problem. That's where we need realtors to come in and tell us, guys, this is the comps that actually support this house instead of the ones he used, and help us with that. So it does come about. Now, clerical errors where they're like cross the T's, dot the I, Those are it's a Fannie Freddie tool that tells us where the multiple errors are and or could be potential error when we sell the loan. Those are again, we're trying to get away from it. We're doing a different process now here at AFN. That it will, we're running the pilot right now with a few branches that we're running through, but I would say by fourth quarter we will pretty much launch it to everybody in the company. That's what we're trying to do, to where certain loans of appraisal values and scores will not require like a full on review. I'm actually working on a checklist to see if we can make it more, not worry about all the, the clerical errors. But to answer your question, the number one things that we see is the comps. If the comps don't support the value and you guys see that on an appraisal and we, we're asking for correction, asking for more comps, which doesn't make sense when we're asking for more comps, when
Yep.
the appraiser provided 7 comps,
Yeah.
need justification of why they're using those comps.
Yeah. So that's why, we always say when you have as a listing agent, if you have any comps to provide the
Yes,
the
please
the
do.
appraisers, at least offer it. If it's a VA appraiser, we don't know if they're going to be like, oh, well, you can kick rocks. I got my own shit, but I can guarantee you any of
Yeah,
the appraisers that are on our panel for conventional and FHA and USDA that they will, at least
and
entertain it for sure. But we do have some more questions too for you, Rick.
sure, of course.
You can definitely meet them at the property because you can give insight to certain things.
Yep.
Why in the world agents don't meet the appraiser at the property is beyond me, but.
You're talking about a listing agent or the buyer's agent? The listing agent. Yeah.
You.
Yeah.
You did.
Yeah.
I want to
Yeah, yeah.
first. So what I want to make sure everyone understands is when a loan officer does a loan, you have 2 underwriters. You have an underwriter that's approving it for approval, and you have a collateral underwriter that's reviewing the appraisal that came in.
Yeah.
What people don't get is on an FHA or a conventional loan, it is sent immediately to both myself and the borrower when it comes in. It has not been reviewed. So the problem we're running into lately with these clerical revisions, we need like a day. It takes one day for my team to get in there and review the appraisal. But what if we're closing the next day? Of course, we ask for a rush immediately. But if we need something commented or updated by the appraiser, we have to go get them to do it next. So I usually try to prep my team. We just had an issue where everyone was losing their minds. Thursday, the appraisal came in and had a clerical revision that was needed. They're closing on Monday and no one understood. First, I asked my team, did you prep the client since the appraisal's coming in so late? While it may be at value and as is, we have to check the document to make sure the T's were crossed, I's. So anyways, we ended up closing it, but everyone was losing their mind. And I said, did no one tell our agents that just because it's in doesn't go? VA loans have 3 days that we receive them before we can release them to you. So at least you guys aren't like jumping the gun. And we just have a lot of clerical issues lately. And when I read them, there are silly things like this one, the MLS for the 2 of the comps provided didn't have a photo. Well, again, they're needed. And again, I'm sure they're running them through AI.
Photos that it's not the front of the house.
Yeah, whatever it is, it's wrong. So we solved it, and so I started going through our emails tracking how many appraisals have came out clean and how many had an issue. And probably 90% have something to be done. Thankfully, most aren't
Ooh, that's a lot, Courtney.
issue. But this
That's a lot.
clerical issue thing is for real. Oh yeah, that's what I'm saying. But I can only fix the problem. We start addressing
Yes.
what the errors are. Do I need to start talking to my appraisal panel about like
Once that
why aren't you submitting that?
they kick back for me to add something, and I mean that's crazy. And the stuff that's added does not do anything except for have a verbiage. So that the company, you guys,
As a piece.
yes. Well, not really you, but I guess higher up.
The investor.
Yeah.
And what I say is our underwriters are now allowing us to close while we wait on the appraiser to say something because it's not going to affect the appraisal.
Right.
That's the next question.
No,
Is that clerical error
yeah.
going to affect the
Well,
appraisal?
and everyone's different. So like Wells Fargo, I could put on there one thing, right? But then I go over to Bank of America and they don't like that. They want you to put something else. So you can never keep in your head just one thing.
That's right.
And what to put in for the verbiage. I mean,
But everyone's like, I have the appraisal. What do you mean? It's fine. I'm like, let me know.
Hey, on that
Go
note,
ahead.
real quick, can you guys please go over what some of like the most common clerical errors are? Because I'm
Yeah, look
like,
at
you
this.
guys are using the example of dotting i's and
It can
crossing
be
t's, but I'm sure it's worse than that. It's more important than just crossing a t. So what are some of the clerical errors that you see that you guys have to fix?
Photos, square footage, ANSI measurements not being done correctly. Those are the major ones actually that come up as far as that are clerical, which doesn't really affect the value, but comes up.
I actually pulled some this morning to just say, what is the most common? Because we only have 3 appraisers on our panel. So if I could just give them a heads up and be like, hey, I'm seeing across the board that we're leaving this sentence off. Because really sometimes it's like, can they
I
please
mean,
add this
I-
sentence? And if
I had one, Jed, that, or I say two. I've had two in the last.
Avoided. That's the biggest sentence that needs to be
Yeah.
added. This could not be avoided.
I've had two that have had the purchase contract. Two separate appraisers of ours had the purchase contract price wrong,
yeah.
just because they didn't put the right number in, right? And I recognized it immediately. Like, this is not right. You know what I mean?
Yeah,
That's what I mean.
Yes.
I had one that they required him to go get a second shot
Yeah.
picture of the garage because he had one angle but not the second
Correct.
angle.
Missing
Yeah.
window.
Because
Missing
you gotta have
something.
front, you gotta have an angle, and you
Oh.
gotta have cross, you gotta have both
Well-
roads.
I think I know that one. Well, those ones come up because there's a the appraiser put a comment that something with the garage.
Yeah.
What is it, Rick?
So if there's a garage, like they'll say there's there was this in the garage, or it was empty and there's nothing in the garage, but they'll take a picture from one side but not the other. Look, I'm actually working on that problem because I actually have the master list of every and I actually have it between every collateral underwriter. So I have all 3 of them and their reviews and what they've conditioned for the past 12 months and the percentage of files that they requested on a 2.5 or less where we've had a rep and warrant. And I actually know the main culprit that is doing it. So we've been talking to, our executives at corporate on what the next plan is with this person because I actually the one who saved him to come to AF. Like he was at AFN in the legal department, and I trained him and got into with Robert and do the appraisal. And Robert Mancini was our chief appraiser. We have a different chief staff appraiser now called Sherry, who does a great job also. But I actually know what the issues are, and so we're resolving that. Because even the clerical errors that have come up, and it's not at a purchase price, that should be, that should be updated, right? Because that doesn't make any sense to have a wrong purchase price when your values is there to support the purchase price. But other than that, the little clerical errors where they're not making comments, those should be going away soon because we actually have a list of all of them. We actually ran the data and found out which collateral underwriter does what and what's not asking for it. And by the ones that are not asking for it have had 178 reviews. No, sorry, not 178. 1178 reviews, and only 3 came back from an investor to request an update. And they barely even asked any updates. So think about it. They did 1178 reviews, and only 3 of them came back from an investor saying, "Can you update the verbiage on something?" So 3 investors, 3 loans out of 1178. While yet this other person who did less, he did about 1,090, 1,080, did less in the past 12 months, but had say about 78% revision request, right? And had 4 come back from an investor for an update. 5, sorry, 5 for an update on something because he asked those questions and then it brought up another question. And so those 5 came back from him. It was crazy, guys. I was just like, oh my God. We're overthinking it. So we're actually going to revamp some of that stuff. And now anything that has to go below, that's below 2.5, that a collateral underwriter wants to add a comment has to get approved by Sherry first. And Sherry promised that she would get to him right away, like not wait a day or anything. Like look at it real quick and say yes or no. No, we're not going to add this condition. We don't need it. So talk to Sherry about it. Talk to our executive team, including Matt and John, who were livid on the call, by the way, when we got the data. They were just
I'm trying to
upset.
track
Like,
that right now. How many times am I getting dinged? Because the first time it's effective closing, because most of the time we have appraisals in and it's
And-
old fashion. Even no one knows.
It's the wild, wild west out there right now. So we're trying to squeeze the life out of every single.
I talked to another.
Me too. You lost me.
I talked to
To squeeze the life out.
I talked to another appraiser at the field. Not know if I want to have this on recording.
I
don't.
don't.
It's my recording, so I guess I can chop it off.
Because he's got a question.
Oh, yeah, go ahead.
So we'll put you at the end.
It's not a question, but go ahead.
I think you just want to know what they
Right.
are exactly.
Tanya?
I mean, you could miss
Yep.
or out
Tanya?
of it as it kills.
So, and that's what so I talked to another appraiser and.
Tanya had one too.
Nope.
What I want
Is it on the same subject?
No.
Okay,
Yes.
give me one second. Let me finish this. I just real quick.
Yeah.
And then I want to
To
go.
go way over if I ask it, so
No, I think it's okay. I think they need to. So I was talking to the appraiser in the field, and he said that he takes a screenshot or a picture of his, and he started putting it in AI to get his clerical ones out to have it checked. And what his percentage.
I feel like it's AI probably checking on my team, because who can do it that fast?
I was like, that's really smart. So I may or may not have also started that.
So speaking of AI, our company is adopting pretty AI pretty strongly with having an AI bot that we can run guidelines through called Brady. It's still in the earlier stages for sure, but I've definitely fooled around with it, and we can upload tax returns and stuff like that to it, and it's not the Bible, so to speak, but it can be a
Yeah, it
reference.
helps. Yeah, it's a good starting point, by the way. And
Yep.
we use another AI to get the data for the appraisal things, by the way. That's what we use to get that data.
There
And
you
it
go.
actually it did a report that would probably take a week for us to do. It did it within an hour for us.
Wow.
Yeah.
So what do you got, Tanya?
So my question is there one thing or anything agents can do either on the contract or during the transaction to make the whole process smoother? Like, what can we do to help you guys out with this stuff?
Oh,
Great
look
question.
at that's a great question because a lot of times what I'm seeing is they're allowing like furnitures and things like that to be left on the purchase contract. You know, honestly,
See a
that's the thing
lot of
that doesn't.
miswritten contracts for approval for loans, right? We can't be, exchanging items, inconsistent, closing costs for the loan programs, uh, repairs, right? And then
Yes.
coming for escrow repairs. At AFN, if you want to escrow a repair, it is like a 7-day review. First, if over $5,000, it can't be unsafe and sanitary and sound. Like if you want landscaping, cool. You want a fence, cool. But when you come and say like we're gonna fix the hole in the wall and all this after
Or
closing,
the sewer.
it's not going to happen. And I just say sometimes people assume it's just going to happen and they do it one day before closing. And I'm like, you cannot get an addendum looking like this. And again, if it was a cash deal, you're good. But this is where it's going through rules. So that's the biggest one I see here. Like again, they're buying investment property and they get 6% closing costs.
That's
But I
okay.
make sure I note it many times that is not allowed. You can only have 2. But on that, I say a thorough interview just like us. The questions we ask are questions you can ask. And I often give in my one-on-one class what I ask. Where are you working? Have you been there 2 years? Have you been divorced? You ever had a foreclosure? Again, because if we're all asking these questions, they can start giving you the excuses.
Are you paying child support?
Correct. It's like,
Or not?
again, the real honesty is just being honest with our clients. If you know about it, tell us. I always say, we're the attorney, the underwriter's the judge. Tell me everything so I know how to work your case. But when you leave it out, we will find it. Again, I had one today, y'all, last night where the agent wrote the EMD for the client and they are not family. Okay? Okay? These are things like we can't do.
Yeah.
We cannot do it. It's not legal. I said, if this was a cash deal, it's fine. We just can't accept it as usable funds for the transaction. So we're going to have her. And he said, well, she couldn't make it to the bank. And I said, but now we got to source it and the check's in your name.
Absolutely.
Like we have some issues with stuff, but I always say like the expectations to the client, just like I said, when we're getting these not critical, I keep calling critical, these appraisal revisions needed. And I tell my team, did you clearly state that we realize the appraisal's not gonna be in right before closing? It doesn't mean we can just close right away. There could be an issue on the appraisal. It doesn't mean it's a value issue, but it might be a correction. But everyone's like, what do you mean? We have the moving truck. And I'm like, okay, it's setting the expectation. When the lender asks for docs, need them in 48 hours. Like the things we don't see cause us the most trouble. There is no reason why we TBD 70% of our files, and we're still missing documents going into that first underwrite. I'm like, borrower, if you want a clean underwrite, meaning we come out, all we need is property, a contract, title, and appraisal, we can do it. But they hold the documents. And the longer they hold them, the more I know something's wrong. And I'll be like, sir, and the guy will be like, well, here's the deal. Like he's a manual underwrite. He's like, I've overdrafted my account more than multiple times. And I said, that's a problem. Because on a manual underwrite, you can't. You can't. I said, how else can we show? And the agent was like, we can work on it. I said, yeah, you can't provide an EMD. We don't need funds other than that. But do I want to lend to him now? Do I want to lend to him when you don't pay your bills on time and you're already manual underwrite? So again, we can all ask questions to clients and set expectations of how soon we need things, because everyone can be pre-approved for real before they step foot in a home. That is not a problem. We will uncover everything. It's just time and the expectations. And when I tell clients, the first thing we're trying to do with the TBD is clear your income. Does your overtime work? Does the equation on your self-employment work? Does the equation we use for your commission work? They told us they were 2 years. It wasn't, it was 1 year and 6 months. You know what I mean? Like, we don't find all that out until someone orders the report.
It's a Best Buy date.
Best Buy.
Yeah. Well,
Lender will tell you
I-
when it's closed.
I want to
Goddamn thing.
I want to say thanks again, Rick, for your
no
support today. And lastly, I want to I can't talk. I want to thank Thomasina here at Coastal Town Realty for having us and hosting this event today. And of course, Jones Walker and Lake for providing the lunch and learn that the people online missed. And yeah, that's pretty much it. And if you want to, Courtney, you want to come over here for a picture real quick? Rick,
Sure.
Yeah,
Team
Rick.
photo.
Rick, we're going to take a picture. So if you want to smile, that'd be great.
I'll smile. Thank you guys.
I didn't know you were. Sorry.
Really, I'm standing in front of you, Rick, but I don't think you can see.
There you go.
It's like we're.
No, I can't see you guys.
We missed you on the sales trip.
Say cheese. 1, 2.
I don't get
3.
invited.
We told him to, trust me. We make suggestions.
Yeah.
They
Okay.
listen sometimes.
I know they do.
Sounds good.
Yeah, you guys. I'm glad you guys did. And by the way, it was great, guys. If you have any other questions, Craig and Courtney will email me. I can get you the answers. If there's something that's your specific scenario, just let us know because we can be a great support and we can help. And of course, we understand it's hard out there, but if we can help your clients, they become our clients. They're your clients. Just help a borrower get qualified in this day and age to get into a home, which we need to. We need to put more people in homes. So we're here to help. So if anything comes up, just let us know and we'll take a look at it.
Yeah. Thank you so much, Rick. We'll be in touch.
All right, guys. Thank you for having me on, by the way. Again, grateful. Thank you, guys.
Super helpful. Thank you so much.
All right. Bye.